Welcome back, guys. Today we're going to talk about the 3 ways and only 3 ways to fix this real estate market coming in 2022 and into 2023. Stay tuned. Good morning, good afternoon, and good evening, everybody. I am Josh Zuniga. This is the Inside View Real Estate Podcast. I'm here with my wonderful host, Carl Freund.
Great intro.
Thanks. I've been brushing up on it. I practiced about 5 times.
Yep.
It's all
Love
good.
it.
But today we're going to talk about the 3 ways that you and I have come up with on how to actually fix this real estate market, coming in 2022.
Dude, there's only 3 ways.
And 2023.
Or anytime.
Yeah. Let's talk about the first one, right? So here's a big thing, right? We've been seeing it on headlines, major tech companies are just having mass layoffs. There's going to be a huge rise in unemployment. We just actually looked up the stat for Q3.
Yeah, can I interject for 2 seconds? Because I want to give you the fundamentals behind why tech stocks really get hurt.
Yeah, let's give a little drip in there.
When interest rates go up, tech stocks are always the first ones to kind of lose ground, right? Because the cost of capital for them increases and they can't borrow to expand. So understand the fundamentals of why interest rates abnormally affect tech companies other than other industries. Mm-hmm. Okay, so let me just put that out there right now. You need to know that. Keep going.
Cool. So as the employment rate has continued rising, we just looked back at the stat of Q3.
Unemployment rate, yes.
Yeah. I don't believe the stat. It said it only went up by 0.2. Is that correct?
Yeah, to 3.7%.
There's no way. I can literally just count off of the headlines that I've seen. There's probably a million people laid off within the last 3 months.
For sure.
From major tech.
Yes.
Right?
A lot of it's happening in tech.
Yeah, okay.
Sure.
So one of the ways that we were talking about things can actually fix the affordability within this marketplace is wages going up.
Yeah.
Okay. That is probably one of the hardest things that's actually going to happen. And that's probably going to the last thing that's going to happen. Historically speaking, if you look at the wage income growth, over the last 10, 15, 20 years, probably even further back than that.
It's flat.
It is literally flat.
Yeah.
Everything else has gone up. Prices have gone up. Homes have gone up. The cost of living has gone up. And our wages have just stayed completely stagnant. Now, if this is going to be a solution, do you think this is actually going to be a viable solution that's going to be within
not in the short term? I can't see it happen in the short term. And so what we did see prior to COVID was really a squeeze on the employment market where there was a lot of competition for employees, right? So we were basically saying, hey, look, I'll pay you whatever you want to come and work for me. You know, we saw that continue through probably Q1 of 2022, and that market kind of switched off, right? So where employers are really pulling back, they're being a lot more conservative. Their cost of raw materials and goods is going up too. So for them to produce a product or service, employees in a lot of industries are probably only a small fraction, maybe 20% of their overall expense. The other 80% is really subject to a lot of inflation too. So when they're seeing inflationary pressures on the other 80% of the raw materials and goods that go into manufacturing or into providing a service, when they're getting a squeeze there, they're going to look at the employees and be like, dude, I don't have any more room to pay you. And so that labor market is going to start to open up as you see layoffs in tech and as you see layoffs in the real estate industry, as you see layoffs in the construction industry. That gap is going to widen, unemployment will increase, and then the inflationary pressure on wages is actually going to go down, meaning that there's going to be less incentive for employers to pay employees more because there's a lot more people available to work. Mm-hmm. Makes sense, right? So that's off the table. What's number 2?
Interest rates. Obviously, this is the very hot topic, right? So we're at 7.5% right now. Literally,
if you're lucky.
Yeah, literally from August till now, October.
Yes.
First week of October. Your payment has probably gone up another $1,000.
Well, yeah, it depends on your price point.
But if you were in the 5s.
Yes, if you're in the 500,000.
If you were getting quoted in the 5s up until now,
okay, so
2%.
2% up.
That is wild.
That's crazy.
Yeah.
And so what you need to understand too is that there's a little bit of dysmorphia here between high tax states and low tax states. Mm-hmm. Let me touch on this for 2 seconds because it's going to go into the third way that we can actually start to fix this shit we're in.
Yep.
So in higher tax states, it's your tax bill. Say if it's $1,000, dude, you can go to New Jersey or New York, and your taxes and your property could be $1,000 a month, right? So if your mortgage is $1,000 a month and your taxes are $1,000 a month, then understand that your tax bill represents 50% over your overall payment, right? In lower tax states such as Arizona, if you have that same $1,000 a month payment on the mortgage, and your taxes are only $100 a month, then now your mortgage component of your overall payment is 90%. Much more sensitive to interest rates. Mm-hmm. Okay, so I'm trying to paint a picture for you here. States like Texas, New Jersey, New York, most northeastern states, the old school states, Illinois, Chicago's a mess. But those higher tax states are really not going to see that price fluctuation as much because the mortgage component is just a smaller percentage of the overall payment. Okay, not sure where I was going with that. But with interest rates going up and down, understand that the affordability gap can really be impacted by a small change in interest rates because it's so highly leveraged. So when you do go only up 3%, you're like, oh, what's 3%? Well, in payment terms, it's massive.
Absolutely,
right? So if you go
is.
from 3% to 6%, yeah, the interest component of your payment is doubled essentially.
Mm-hmm.
But it's only a 3% increase in interest rates, but it's highly leveraged. So what we did see back in, probably Q4 of 2021 when we're at 2.875%, or even Q3 of 2021, we saw in the brief moments of 2.25% when we were really getting aggressive with rates. And then the government was subsidizing a lot of the mortgage-backed securities market. God, I'm going deep on this thing. So the government, guys, you should understand, back in 2012, they started to subsidize and basically buy these mortgages, artificially depressing the interest rates required, because the government doesn't need to make a lot of money on these loans, but private institutions do. The government did pull out of that mortgage-backed securities market, I believe in May or June of 2022, which left private institutions to fill that gap, got them going even deeper, and causing interest rates to go up even more than what we've seen. Now we have inflation, and you can see the that's going on. Okay, quack that out. And so what you're going to see here is that as rates go back to basically stoichiometry, which is like the perfect equilibrium between, what the private institutions need and what they see for as far as inflation or required what the people want to pay. Honestly, mortgage markets should be in the 5.5% to 6% range for a 30-year fixed conventional loan, which is what we see in the government subsidized loans right now, FHA and VA. So we have a problem right now with inflation high. I cannot see interest rates coming down in the foreseeable future. I'm talking about 6 to 9 more months. Now, the Fed keeps raising interest rates on the federal funds rate, which we've talked about in previous episodes, quickly, right, to really tampen or reduce the amount of demand for capital, because it makes capital expensive. You're not going to borrow money at 40%, right? You borrow as much as you could at 0%, which is what we've seen. That's exactly if I give you a big spread there. And so we are in a really, really tight place, which only leaves one more correction available to us. What is that? What is number 3?
Price reductions.
Price reductions.
Yeah. And so nationally, last time we had an episode on this, we saw 83 markets that were down. Now they're saying there's 156 markets. I just read an article, just the other day, on that. So within Arizona, we definitely have seen, probably a 15 to 22% reduction in price based off of your area. That's not every area. That's just saying for the greater Maricopa, Phoenix area here, within Arizona. Mm-hmm. The other markets have been hit, significantly higher, than that. So are these rates, this is the biggest thing. Obviously, everything's going to be predicted off of these rates and the buyer sentiment going into these markets, right? So as rates continue to stay or continue to elevate, price reductions are going to continue to keep going down and down.
They have to until we reach equilibrium where the average person making an average wage can afford an average house.
That's a long ways away, in all honesty. If we continue to go up for 6 to 9 months and we still have the reductions, in all honesty, right? If the payment increased by $1,000, say in the last 3 to 5 months, okay, that house would have to be reduced by almost $100,000 just to make up for that difference.
I believe it's more than that, dude.
Probably yes. I think we did the calculation. It's like 110.
So I think we ran the numbers on it. We did training the other day. My days are all kind of messed up, but we said back when interest rates were like 2.5%, a $500,000 house would be equivalent to a $900,000 house. So the payment differential between those rates. So let me say that again: a $900,000 house at 2 point whatever percent it was is the same payment as a $500,000 house at today's rates.
Yeah,
there's a $400,000 gap there that you have to cover. That's a big gap, man.
That just tells you. It's obviously with wages not increasing, interest rates still rising, prices still, obviously at a good price, if you're still a home seller and they haven't dropped substantially, but who's to know once, quarter one of 2023 actually happens, what's that's really going to look like? And just like we were saying, we had this on a different episode. If that black swan event happens, we get attacked or there's some, introduction to war, that's going to create a lot of havoc, in a lot of people's minds, and a lot of markets, not just the real estate market, are going to be affected by what's actually going to be happening and occurring with them.
Yeah, man. I mean, the best way to get us out of this, honestly, is for the government to manufacture war. Not to get political or anything, right? But I mean, if you look at historically what's happened, every time we get into economic trouble, what happens very shortly after?
Rise.
We get a war, right? And so it's happened almost every decade, like clockwork, dude.
Yeah. And you see it, guys. If you take a look at like how many times you've entered war, it's usually every 10 years. So we essentially are overdue.
Yeah. I mean, if you
we
think
are
about it that way.
overdue. I'd hate to say that, but we are overdue for some
event
to actually occur. And I think setting up with this next election is probably going to be the pedestal that it's going to happen and occur on. I don't want any a part of it. I don't want anybody to actually, go overseas and do anything like that. There's going to be a lot of families and people that are going to be affected by that. And
a lot of people die and get hurt, man. It's
unfair,
not cool.
man. It's unfair.
Unfortunately, I think our government is the one that's going to manufacture a lot of that.
Yeah.
And so it's really disappointing.
Yeah, it is. So we'll end on that, guys. So the only way for this actually market to correct itself, and by the end of this year or even next year in 2023, it may even continue in 2024. Number one, it's going to be wages. Number two, interest rates actually have to decrease at some point in time. Number three, the only way to actually cover that gap, if those other two don't work, is going to be reducing prices.
Nailed it.
All right, guys, thank you so much for tuning in to today's episode. We'll see you on the next one.